Okay, good morning, everyone. Welcome to the session today. Today will be day 28 or 29, I guess, where we'll be discussing on introduction to group profit or loss and other comprehensive income. How do we proceed in consolidating parent and subsidiary account from the perspective of the statement of profit or loss and other comprehensive income. And that also will be extended towards consolidating the respective statement of changes in equity. And we are going to build upon what we've discussed severally in the past few weeks with respect to consolidated statement of financial position. All of the principles apply equally to statement of profit or loss, except for the fact that in the statement of profit or loss, we are only talking about consolidation of period transactions in terms of performance, unlike balance sheet, where you are consolidating the cumulative effect of transaction over a period of time. Okay, and that's what's going to be today. And I believe all of us have access to the material, and one of those things we'll be discussing in this session or chapter is going to be how to appreciate and understand the process we need to follow, which is iterative in nature towards consolidating a profit or loss and other comprehensive income of the parent and of the subsidiaries, and how the profits of the group can be attributed to the parent and also to the non-controlling interest. Okay, you're all welcome to today's session. And before we proceed, I want someone to volunteer to make little readings about certain things that would lead us to the discussion with respect to consolidation of the statement of profit or loss and other comprehensive income of the parent and subsidiary, and likewise of the consolidated statement of changes in equity. Who is going to volunteer to read this expression to us as we move on? Who is volunteering?
I don't want to read this sentence, sir. I'm reading it, sir. I'm reading from my phone, sir. So it's a little bit.
Okay, can somebody else read if you can't see it clearly?
Okay.
Bashir, yeah.
Extension of basic consolidation mechanics and principles in the preparation of statement of profit or loss and other comprehensive income and statement of changes in equity. As in the statement of profit or loss and other comprehensive income and statement of changes in equity of a single entity shows the result of the year operations. So does consolidated statement of profit or loss and other comprehensive income and consolidated statement of change in equity shows the result of trading in the year by the parent with its subsidiaries. Mechanics of consolidation. Consolidated statement of profit or loss and other comprehensive income and consolidated statements of changes in equity is the combination of statement of profit or loss and other comprehensive income and statement of changes in equity of the parent and its subsidiaries after making adjustments as it relates to intra-group transactions, i.e. elimination of intercompany items, unrealized profits, and so on, and other related adjustments. The basic idea is to present one set of financial statements for all entities under common control. In the context of the statement of profit or loss and other comprehensive income, this implies presenting the result of all members of the group, i.e. the parent and all its subsidiaries, in a single but considered consolidated statement of profit or loss and other comprehensive income. As far as the consolidated statement of changes in equity is concerned, this means just one statement dealing with all entities in the group. The entire financial performance within the statement of profit or loss and other comprehensive income are a simple aggregation of the result of the parent entity and all the subsidiaries. Non-controlling interest is ignored in the aggregations, as with the consolidated statement of financial position already considered within the context of this text. Non-controlling interest. In consolidating the result of the partly owned subsidiary, it is essential to note that the profits or losses of the subsidiary belong to both parent and non-controlling interests, which have to be shared in the proportion of percentage holdings or investments in the subsidiary. IX1, presentation of financial statement, states that profits for the period must be analyzed between the profits attributable to non-controlling interest and profits attributable to equity holders, ordinary shareholders of the parents. Reserves brought forward. It is essential to calculate or determine the amounts of reserves, which included the retained profits or accumulated losses brought forward at the beginning of the period stroke year from the previous year. For the purpose of consolidated financial statements, the consolidated retained earning one, parents' retained earning brought forward plus parent share of post-acquisition retained earning of the subsidiary.
Okay, thank you very much. Thank you very much. That has laid a foundation. And what is the foundation? The first foundation there is very simple, that in consolidating the parent and subsidiaries profit or loss, we are going to do that by simple aggregation subject to adjustment on a line-by-line basis. Revenue, cost of sales, administrative expenses, other expenses, income, and etc., up to the tax level. Secondly, that in doing so, whether it is wholly owned or partly owned subsidiary, NCI would not be considered in the aggregation, as it is that since the parent has full control over the affairs of the subsidiary, is going to consolidate all of the transaction and profit 100%, regardless or without reference to the percentage stake it has in the subsidiary. But what then happens is that at the end of the day, the profits from the group perspective will have to be attributed to that of the NCI and that of the parent entity. Okay, that is that. Now, and that is in compliance with the requirement of IS1 when it comes to presentation of a general purpose financial statement. Another key issues that we have highlighted is that the consolidated reserve brought forward have to be identified before we can add up to it the parent share of the profit in the group for the current period. But how do we obtain the reserve brought forward or the consolidated retained earnings brought forward for the group? It is determined with reference to one, what is the retained earnings brought forward for the parents, plus two, what is the parent share of the post-acquisition retained earnings brought forward from the subsidiary. By having this, we'll be able to arrive at what our consolidated retained earnings brought forward will be for the entire group. I remember everything with respect to consolidated retained earnings is all attributable to the parent entity. Why that attributable to non-controlling interest will have been taken care of in determining the amount of non-controlling interest within our statement of changes in equity. And we're going to see that by various illustrations. But before we proceed on various illustrations, what we're going to also do is that we will consider these basic consolidation techniques. And I want somebody to volunteer to read it out. What this is telling us is that if you follow these steps one by one, the end product of it is that you will have successfully produced a consolidated statement of statement of profit or loss and other comprehensive income. And likewise, you'll be able to produce the consolidated statement of changes in equity. Who will volunteer to read at this point?
Okay, let me continue.
Okay.
Basic consolidation techniques. As earlier considered in the early chapter of this text, it is significant to primarily identify the group structure, as once again, we only consolidate the parent and subsidiary results. In this case, financial performance from the date of inclusion, which is the first date of the parent obtains the control of the subsidiary, i.e. acquisition date. Again, we will be applying the single entity concepts. Recall, consolidation entails parent results plus subsidiary results, plus or minus any adjustments. Step 1. Identify the group structure, i.e., which company is the subsidiary. Step 2. Eliminate any intra-group sales between the parent and subsidiary, not the associates or joint venture. This will be discussed later in one of the chapters. This will result in 1. Decrease revenue. 2. Decrease cost of sales. Step 3. Eliminate any unrealized profits, including inventory from intra-group sales. This will result in increased cost of sales. Technical notes. Remember, closing inventory is reducing, hence causing the cost of sales to increase. Step 4. Make any other adjustments for current year additional depreciation due to any fair value adjustments or current year impairments. Implication: increased expense could be costs of sales, administration, distribution, minus follow examiner instruction or use the most appropriate. Step 5. Remove any intra-group interest relating to intra-group loans between the parent and subsidiary. The implication: decrease investment stroke interest income or decrease finance costs. Step 6. Remove any intra-group dividends. Implication: decrease investment income. Step 7. Calculate the share of associate stroke joint ventures profit and add to the group profits.
Thank you very much for that. All of this, you don't need to bother yourself about them majorly, but as we move on, you find out that all of these steps are what we are going to take into consideration at every point in time. Okay, to start this journey, we are going to make use of certain illustration, and we'll start from various principles. From my own approach, I'll call some first, second, third principle. those principles are just build-up principles to having better understanding of what we are to do. And the first point of call of consolidation is where we assume that a subsidiary is owned 100% or only owned by the parents. Okay, and that is what we are trying to look at here. Now, if you find yourself in a situation where the subsidiary is only owned by the parent, okay, which means there's no non-controlling interest, and you are required to consolidate, what would be your position at that point in time? Okay, now what I'm going to do first is to more or less bring this out and let us try to consolidate. Okay, I'll cut this question out and try to attempt solving it. I want someone to read this as I share it. Okay. And now, will you volunteer to read this question?
Okay. I will. I just use my phone, so I'm just trying to read. But I will. I mean, so illustration 1. ISANA acquired 100% interest. Can you hear me? Hello?
We can hear you.
Okay.
We can hear you.
Okay, fine.
We can hear you.
ISANA acquired 100%
Yes, you can hear
interest.
you. Yes, you can hear.
ISANA acquired 100% interest in the equity of Chelsea as at January 1st, 2014, when it was incorporated. The board of ISANA strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. ISANA on the left, Chelsea on the right. Revenue, everything in thousands. Revenue, ISANA 600,000. Chelsea 390,000. Cost of sales, ISANA 345,000. Chelsea 201,000. Gross profit 255,000 for ISANA, 189,000 for Chelsea. Distribution costs 25,000 for ISANA, 45,000 for Chelsea. Administrative expenses 105,000 for ISANA and 90,000 for Chelsea. Then we have income tax 25,000 for ISANA, 29,000 for Chelsea. Then we have movement in reserve, retained profit brought forward, 120,000 for ISANA, 65,000 for Chelsea. Profit for the year, 50,000 for ISANA and 25,000 for Chelsea. Okay, retained profit carried forward, 170,000 for ISANA, 90,000 for Chelsea. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share of capital of ISANA stood at 200 million and that of Chelsea amounted to 100 million.
Okay. Thank you very much. Let me share, we'll be making use of Excel to solving this problem for 2 reasons. One, for those writing diploma in IFRS with the ACCA, it will be computer-based, and this is how you're expected to do that. And for those that for practice purposes, this is how you start to more or less make use of tools in solving business problems within your organization. Now, what we need to do, as I've done it here, is to put it on Excel, okay? Okay, now let me start with what I have here. Okay, now I'll try and replicate this. Okay. Now, all things being equal, okay, now I'll create what I will call consolidation schedule. Okay, I'll create it somewhere here beside it. For profit or loss and other comprehensive income. Okay, let me shorten it, and OCI. Okay, in that schedule, what I'll do is to have the following. The parent column, the subsidiary column, the group adjustment column, and the group, which is a consolidated section. And the beauty of it is once you develop it once, it becomes a template you use going forward. Okay, now the first thing I'll do is to go back to my question. And try to bring in the raw data the way I have it in my question. Now what next? I'll pick my subsidiary. Okay, now I have it the way it is here. Let me do something for us. Okay, I try to insert things that make it easy for you to see the negative side. Okay, Okay, once I'm able to do what I'm doing presently, we can proceed. Now, what is the consolidation for profit or loss? We said it's a mere aggregation. And what is the aggregation here? It is the sum of the parent and subsidiary line-by-line items in the statement of profit or loss and other comprehensive income, subject to adjustments, which I will extend to group adjustments. And what are the adjustments? As you are aware earlier, we're going to see various adjustments, some that we have more or less considered in the process of preparing the consolidated statement of financial position, which is otherwise known as the consolidated statement of, that is consolidated balance sheet. We are going to replicate all of that at this point. Okay, now since there was no intercompany transaction, there was no adjustment to our revenue. Therefore, the group revenue will be merely that of the parent and that of the subsidiary. Likewise, there's no adjustment to cost of sales in this question. Therefore, we bring it down and say, what is the value here? It's for us to sum this also across board. Now, invariably, what is our adjustment to distribution cost? Our adjustment to distribution cost is nil because we don't have any intercompany transaction that requires elimination. Likewise, to adjustment. And in that case, we also sum this together. Now, there's no adjustment to our income tax expense at this level, and which means at the simplest level, consolidating this is just a mere aggregation. But as time goes on, we'll see better appreciation of what it is. Okay, now the first thing you then do is to more or less link everything in your consolidation schedule to your main account. And that's what I'll do at this point. I link that with this, and I do that for everything as I move down the ladder. Okay. What's the sum of this? My distribution cost, my admin cost. Now, both I can simply aggregate it as my operating expense. And from there, I can determine my profit before taxes. My income tax, I link it to my schedule. Now you see the relevance of this schedule as we move on when it comes to various adjustments. At the end of the day, I have my profits. for the year. This is from the group perspective. Okay. Let me create a border between them so that we don't mix it together. Now, this profit for the year are to be attributed to the underlisted in line with the requirement of IS1. The portion that goes to owners of equity of the parent, which in this case is Arsenal, and 2, that is attributable to non-controlling interest, NCI, that is the others. Now, this sum have to be attributed to the parent and NCI. How do we do that? Profits attributed to, I'll pick it one by one, the parent, and to NCI. Once you create this template once, going forward, all your consolidation processes will be straightforward. Now, let's pick them one by one. The first item is to more or less consider profits of the parent. The profit of the parent, which is this 50,000, only goes to the parent. NCI is not a partaker. Whereas the profits of the subsidiary will have to be shared between the parent and subsidiary in the ratio they share profits or loss. And what is it? In this case, there's no non-controlling interest, therefore 100% to 0%. That is 100% to parent and 0% to subsidiary to NCI. Why? Because NCI does not exist in this case, because this is a wholly owned subsidiary. Okay, in this case, what then do I do? Remember, I can create something here that shows, let me just create it so that I can assist us at every point in time we need it. Parent is 100%. NCI is the difference between 100% and the parent. That is the 0%. Which means if parent is 80, NCI will be 20, for example. And this is how you model templates such that you don't need to be changing all of the variable at every point in time. You link everything to one source of data or parameter. Now, the products of this and the profits of the subsidiary will be shared among these two parties. Because this is 0%, nothing goes to the NCI. But if this is 80%, 20%, 5,000 comes to this level. And that's what we are trying to do here. Okay, take note of it. Now, other adjustments. But in this case, there are no other adjustments. If there are other adjustments, we take them out. But in this case, there are no other adjustments. Therefore, because in the question given to us, no adjustment is required since there is no intercompany transaction, which then means invariably what we have simply done is to determine what is their profit attribution. But I return this back to 100% parent because it's fully owned, which means the entire 75 million is attributed to the parents. Or 75,000, and nothing to non-controlling what? Interest. And that is how we present our consolidated statement of profit or loss. And in this question, there is no other comprehensive income yet. Now, any question at this point? Any question at this point? Let me read this. Any question, please? See where the work is at the consolidation schedule level. And once you're able to get it right, that is a line-by-line consolidation. We surely move on from that perspective. Okay, now the next audio is the statement of changes in equity. Now, since you don't have non-controlling interest, how will our statement of changes in equity look like? Okay, let me try and put it on this point. Consolidated statement of changes in equity. Now, what are the items I have? I have my share capital. I have my retained earnings. I have my equity to the parent. I have my NCI, and I have my total equity. Okay. All my figures in thousands of naira. We start with our balance as at beginning of the year. You now have your profits for the year. Thereafter, you have your other comprehensive income. if any. But in this case, it seems we don't have. And our transactions with owners of equity, if any, which in this case, it seems we don't have. And from there, we have our balance as at end of the year. Okay. Okay. Now, let's start from simple information here. We are told that prepare this consolidated statement of profit or loss and statement of change in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea stood at 100 million. Okay. Now, share capital that is relevant to us is the share capital of Arsenal, which is the parent. Remember, the process of cancellation will have taken care of the share capital of Chelsea in arriving at our goodwill. Okay, now our opening retained earnings will come back to that, which we are going to make reference to, but I will highlight it in yellow. Those are the critical areas that requires our attention. And what is our equity to the parent? It is the sum of the share capital and the consolidated retained earnings, which is 200. Take note of that. And I can sum this up. Yeah. Now, NCI. There's no value for NCI since we are aware of the fact that this is 100% owned, which means our value for NCI is 0, but we are going to see a situation where NCI is not 0. How do we determine that? Our share of profits, the parent is entitled to 75. We link it. NCI is entitled to 0. Why? Because if you go by this, NCI was 0%. If I change this to 80, you find out that by the time you come here, that profit for the year has been split between 70 and 5 for both the parent and the NCI. Okay, now there are no information about other comprehensive income or transaction with owners of equity, which means both at NCI level and that it is 0. Okay, therefore, I sum my total equity, being the equity attributable to the parent and that attributable to what? NCI. And I sum it up across the border in this manner. Therefore, I sum every item up and that gives me this. But there's still something missing here. What is missing here is my consolidated retained earnings brought forward. And if you could remember, what did I say about consolidated retained earnings brought forward? Let me go and cut it out for you so that you can remember when you are practicing on your own. What we said here is this. Can somebody read it out again?
Okay. We said reserves brought forward. It is essential to calculate or determine the amount of reserves which included in the retained profits or accumulated losses brought forward at the beginning of the period or year from the previous year. For the purpose of consolidated financial statements, the consolidated retained earning brought forward consists of parent retained earning brought forward plus parent share of the post-acquisition retained earning of the subsidiary.
Okay. Therefore, consolidated retained earnings or reserve is also applicable to any reserves brought forward. How do you arrive at that? You arrive at it as follows. As the parent retained earnings brought forward. What is the parent retained earnings brought forward? If we go back to our question, the parent retained earnings brought forward is 120. Therefore, come here, 120. And share. Share in this case is 100% of the post-acquisition retained earnings brought forward for the subsidiary. How do you determine that? How do you determine that is simply as follows. Your percentage multiplied by the brought forward retained earnings RE means retained earnings minus pre-acquisition profits or loss. Take notes. This is the formula. which means once you have this, we can always get solution at every point in time. Now the question then is, what is our percentage? Okay, it's 100%. Therefore, let me turn this to 100%. Our percentage is 100%. I will link it, as you can see here, multiply by our retained earnings brought forward by the subsidiary. If you check our question, it is 65. Can you get it? Okay. 65,000 minus pre-acquisition reserve. Now, in this question, what is our pre-acquisition reserve? Our pre-acquisition reserve in this question is what? Who can answer the question? What's our pre-acquisition reserve in this question? What's our pre-acquisition reserve in this question?
It's 65,000. Are we?
Our pre-acquisition reserve in this question is what? It says 65.
No, I don't think
Let
so.
me read
No,
the
no,
question again. It says,
that's
ACTI
not it.
acquired 100%. Okay, what's our pre-acquisition reserve? What does this phrase implies?
It was a zero. It's a zero.
Why is it zero?
Because
Why
we
is it
acquired
zero?
it when it was acquired when it was incorporated. So it's
Yeah, which means at incorporation level, there's no reserve. Reserve at incorporation level is zero. Therefore, it's zero. And that is it. And once I'm able to do that, it gives me 65. Now, what I can do is this, I can create something here that will always assist me to say, I need pre-acquisition reserve so that I can link it. I need subsidiaries, retained earnings brought forward. I need parents, retained earnings brought forward. Once I have those three information, these three information, once I can input them at any point in time, from the question, this is 0. From the question, this is 65. And from the question, this is 120. Therefore, since I want to develop a template for it, so that going forward, I won't be Going forward, I won't need to be typing. And this 65, I'll go to the cell. The 0, I'll go to the cell at every point in time. Okay, which then means that if peradventure we have pre-acquisition reserve of 10,000, automatically adjust what I need to do. Okay, that is that. Now, that is what we've done here. And that 85, I'll put it in yellow to show where it's going to. It's coming here, which is our consolidated retained earnings brought forward. Is the addition of that plus the profit for the year will give us our consolidated at the end of the year. Any question in this regard? That is our position. Which means invariably what we have done is we have provided you with how to consolidate. This is the simplest consolidation you can come across. But it's on this simple basis that we are going to build upon in arriving at where we are going to. Any question before we look at other situations? Any question before we look at other situations?
Sorry, the only area where I have a bit confusion is where we determine the pre-acquisition retained earning. I understand the formula, but I want a situation whereby it won't be something that I clearly with the clarity of the formula. I'm still trying to process what we input in my memory, but I can't still get how to go about it.
No, I'm not getting your question. I'm not getting your question.
No, it's not a question. I just need more clarity.
Your question is not clear. This is, can you?
Hello, sir.
Now, look at the formula here now.
Okay.
The formula is so simple. It is the percentage of the parents Can you get it here?
Yes.
Is a percentage of the parent, which in this case, let me just replace it so that if you want to work with formula, you don't need formula, but if you want to work with formula, you can see it clearly there. Now, to determine your consolidated retained earnings, what you need to do is what we've done here. Remember, we said you need the parent retained earnings brought forward, which is what you have here, 65. Sorry, where's it? 120. You needed your share of the post-acquisition retained earnings brought forward. Your share is the percentage of the parents. Now, what is the post-acquisition retained earnings brought forward? Is the difference between the retained earnings brought forward after deducting your pre-acquisition reserve. Remember, your pre-acquisition reserve will have been deducted to determine the net asset as at the date of acquisition, which has been cancelled out in arriving at goodwill. Therefore, you can't eat your cake in determining goodwill and still have your cake in determining consolidated retained earnings. Can you go back to what we discussed there?
I remember.
And that's why we are taking that out.
Okay.
What you have eaten, you can't have it at the same time, except it's still one. Did you get it, sir? I can't hear you, Nodrin.
I get it.
Okay, thank you very much. Any other question? Now, this took us so long because this is the first time this took us so long because this is the first time we are developing the templates. Going forward, you will see how it's going to assist us in solving more of other problems as time goes on. Okay. This address question 1. I'll replicate this template so that we can use it for question 2. What's question 2 now? Let's go back to our material. Now, if you come back here, you find out the solution is similar to ours. Okay? You can read that up. Let's now look at another question. Another question is this. If you find yourself in this situation, now let's look at our situation now. Let me share my Excel with you. Now look at the question we have now. Who can read the question out? Can somebody read the question out?
Mr. Neodin, help us, sir, please.
Illustration 2. ACTI acquired 80% interest in the equity of Chelsea as January 1st, 2014, when it was incorporated. The board of ACTI strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at 31st December 2016. Income statement for the year ended 31st December 2016. ASNA Chelsea, all figures in thousands. Revenue 600,000 for Chelsea, 390,000. Cost of sales 345,000 for ASNA, 201,000 for Chelsea. Gross profits 255,000 for ASNA, 189,000 for Chelsea. Distribution costs 75,000 for ASNA, 45,000 for Chelsea. Administrative expenses 105,000 for ASNA, 90,000 for Chelsea. Profits on before tax 75,000 for ASNA, 54,000 for Chelsea. Income tax 25,000 for ASNA, 29,000 for Chelsea. Profit for the year, 50,000 for Arsenal and 25,000 for Chelsea. Movements in reserves. Retained profits brought forward. Arsenal 120,000, Chelsea 65,000. Profit for the year. Arsenal 50,000, Chelsea 25,000. Retained profits carried forward 170,000 for Arsenal and 90,000 for Chelsea. Require prepare the consolidated of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interests at acquisition as measured at fair value stood at 20 million. Fair value.
Thank you so much. Now, this question is exactly the same question. But what is the critical difference in this question is that as opposed to that other question, in this case, Arsenal only acquired what stake? Arsenal only acquired 80% what? Stake. Can you get it? Now, this 80%, I'll come here to recognize that 80% is the parent stake, which means NCI will be 20%. This information remained the same, and there was no account of any intercompany transaction. And in that case, what should happen is that all of the group adjustments are nil, and I consolidate on a line-by-line basis. Very straightforward. Now, this 75 have to be splitted into portion attributable to the parent and attributable to NCI. How do I do that? It is that of the parent, which goes 100%. Let me highlight it in color. Which goes 100% to the parent, while that of the NCI, which will be shared between the parent and NCI, let me also highlight that in color, and which will be shared in ratio 80-20, which means I'll come here and say ratio 80 and what? 20. Now, if there are adjustments, we are going to look at those adjustments one by one as time progresses. Invariably, this 75,000 has been split into 70 and what? 5, given that the information remain the same. Now, let's come here. As an acquisition, it was during the period of incorporation of the subsidiary, which implies that our pre-acquisition still remain at 0, which you can find there. Is 0. Now, subsidiaries profits brought forward still remain at 65. Parents retained earnings brought forward still remain at 120. Now, how do we determine this? The question then here is, the only changes here is the percentage of the parent, which is now 80, and that has been built into our formula. Which that means that if I have to come here, I'll simply say this is what? 80%, which is the parent. Also, which is 80% here. What is our reserve brought forward? Our reserve brought forward for the subsidiary is this 65 minus pre-acquisition reserve, which is 0. And 65 minus 0 is 65. 80% of 65 is now 52, which when added to 120, we have 172. which flows into this place. I remember, since we have modeled it as a template, our profit attributed here flows to our statement of changes in equity, 70 reported under consolidated retained earnings, which is in the books of the parents, while 5 reported within NCI. Now, what is also new is the amount of NCI as at acquisition. What is the amount of NCI as at acquisition? Let me find a suitable color. I think this is too dark. Okay. What is my NCI? My NCI is now 2. What is the amount of my NCI? No, 2. At the start of the year. That's as at the beginning. My NCI as at the beginning of the year will be my NCI as measured at acquisition date, which you all know that it can either be measured at proportionate share of the identifiable net asset acquired at the acquisition date or at acquisition date fair value, either of that. And share now will be NCI share, which in this case is 20%. Which means the same thing you did for the parent is what you do for NCI, but you now take NCI's own share, not the parent's share. Now, what is NCI share? I come here, the examiner gave us the information that NCI as at acquisition was measured at fair value, which stood at what? 20 million. Now, this 20 million has been given to us on a platter of gold, which we know also how to determine that. Therefore, I come here and put additional information. What kind of additional information? Non-controlling interest at acquisition dates. How much is it? 20. Okay. Therefore, I will link that to this. Now, this same formula I have for the parents, I will also copy that formula and use it for the NCI. The only thing that is different there is the parent is taking his own percentage. NCI is taking his own percentage, which means instead of 52, which is the percentage of parent, I'll come here to change it. Which percentage am I using? I'm using the percentage of the NCI, which is 13. And at the end of the day, what do I have? I have 33. Now 33 is what I will now bring here, which I will link as my NCI brought forward, which means the value of NCI brought forward as at any financial year is the value of NCI at acquisition date plus NCI share of the post-acquisition retained earnings brought forward in the subsidiary as at the beginning of the year. That is that. Which means on that basis, we also have this position. Any question? Now, invariably, everything we've done has flown to our main solution. What's our main solution? Our main solution is this, which you can see our group revenue, our group cost of sales, our group gross profit, our group administrative cost, our group administrative expenses and distribution costs, our group profit before taxes, our group income tax expense, our group profit for the year, which is attributable as follows. That due to the owners of equity of the parents, and that due to non-controlling what? Interest. And that is just it. Any question? Any question here? Any question? Enaro, any question? Tobilayo, any question? Siami, question? I want to hear you guys out.
No question. Question from my end for now.
Okay. Now, let's now replicate this again, because we'll be building on it one by one until we get to the promised land. Let's attempt solving another question. Probably we'll call it question 3. Therefore, I duplicate this again. Now, what is question 3? Now, the third question will expose us to where we have pre-acquisition reserve. What influence would that have in our whole process of consolidation? Okay, who can read this question for us?
Okay. Question 3. ACTA acquired 80% interest in the equity of Chelsea on January 1st, 2014, when the retained earnings stood at 20 million. The board of ACTA strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parents as at 31st December 2015. Income statement for the year ended 31st December 2016. ACTA Chelsea, all figures in thousands. Revenue 600,000 for ACTA, 390,000 for Chelsea. Cost of sales 345,000 for ACTA, 201,000 for Chelsea. Gross profits 255,000 for ACTA, 189,000 for Chelsea. Distribution costs 75,000 for ACTA, 45,000 for Chelsea. Administrative expenses 105,000 for ACTA, 90,000 for Chelsea. Profits before tax 75,000 for ACTA, 54,000 for Chelsea. Income tax 25,000 for ACTA, 29,000 for Chelsea. Profit for the year 50,000 for ACTA, 25,000 for Chelsea. Movement in reserves. Retained profits brought from 120,000 for ACTA, 65,000 for Chelsea. Profit for the year 50,000 for ACTA, 25,000 for Chelsea. Retained profits carried for 170,000 for ACTA, 90,000 for Chelsea. Required. Prepare the consolidated profits or loss and the consolidated statement of changes in equity, given that the share capital of ACTA stood at 200 million and that of Chelsea amounted to 100 million. And the amounts of non-controlling interest at acquisition measure at fair value stood at 24 million.
Thank you very much. The same question, but what is the difference? The difference is in the fact that as at acquisition, the retained earnings stood at 20 million, while all other information remained the same. And secondly, the fair value of the non-controlling interest as at acquisition stood at 24 million. Why all other information remain what? The same. Therefore, we'll come back here. This has not changed. The whole process here has not changed. The percentage stake has not changed from 80%. But what has changed is that the pre-acquisition reserve is no longer zero because we didn't acquire at the point of incorporation. Rather, we acquired sometime in 2014 when the reserve of Chelsea was 20 million. Therefore, I come here, I change the 0 to 20 million. What that signifies is that when we get here, it's going to affect the available reserve for distribution having taken out pre-acquisition profits, which means this will no longer be 52, neither will this be 13. Having taken out the 20, which by the time I press enter, you find out that what is left out of 65 to be distributed is 45, and of which 80% of 45 gives 36 to the parent, and 20% of 45 give what? 9 to the non-controlling what? Interest. And invariably, that changes our position here and here to obtain our consolidated retained earnings brought forward and the amount of NCI brought forward. Does that make sense to us now? And now I want to hear you, Tiamiyu. I can't hear your voice. Tomilayo, I can't hear your voice.
I think it's clear. It's clear. That's why using the formula makes it easier. Just to, there's no formula again. Of course.
We just need to go over it again after the class.
It's very clear to me.
What do you say?
It's very clear, very clear.
Okay, Wale, what is it to you?
I said that I just need to go over it again. The Excel sheet. Go over it again and do it again myself.
And NCI has changed from 20 million to what? 24 million. And that is what you can see here. Okay, take note of every changes here. Therefore, once you come here, this has not changed. Our statement of changes in equity has slightly changed from what we have here and here. And that is attributable to the fact that pre-acquisition reserve is no longer zero, it's 20 million. And fair value of NCI is no longer 20 million, it's now 24 million. And that is that. Okay, what I will do for you is that I will share this slide with you and I'll give you a question for you to attempt. Let me try and share this slide with you guys. But before then, I want you to use that to solve a question. I'll call the question 3B. Let me pull out a question for you guys. I'll call this question 4, as it was. What I'll do is that I'll share this on your WhatsApp platform. Please pick it up from there. And I'll give you 10 to 15 minutes to peruse it. I will convert, okay, I'll give you just 12 minutes to peruse it. We'll convert back 1 o'clock. But what are going to happen is that you guys can discuss it on your own, but you must ensure you populate your own table. Okay, now let's look at it together and let's try and solve it. First thing is that we need to check all this information here, whether they are the same. Otherwise, we need to do the needful. Where the changes started from is administrative expenses. It's not 105, it's now 107. Therefore, I'll come here. Okay, and there's dividend income. Therefore, I have to bring that in. dividend income. $2 million, 0. Okay. Okay, all other things remain the same. Now, from the information here, ASNA had 80% stake. And that is what influenced our 80-20 here. Okay, and when the retained earnings was 20 million, that influenced what we have here. The reserve of the parent brought forward was 120, NCI, that's a Chelsea subsidiary, 67. Therefore, that will have to change from 65 to 67.5. Okay, and the fair value remain at 24 million. That will not change. Okay, now, what is the issue here? The issue borders on dividend income and dividend paid. Recall, when the parent paid dividend, the parent is expected to have paid dividend to all the shareholders, which is made up of the parents and others, which are NCI. Parent will take 80% of the share of that dividend, and NCI will take what? 20%. Now, when you check it, 2.5 million was paid as interim dividend by Chelsea. That means that 80% of 2.5 is 2 million. And 20% is 500,000. Therefore, what happens? You now find out that that 2 million was what was recognized here by the parent in his books. Which then means that this constitutes intercompany transaction, which have to be eliminated. Okay, which means at the parent side, we eliminate the income because dividend income is a subset of the profit that is attributed to the parent from the subsidiary. Therefore, we will reverse the dividend and knock it out with this 2.5, leaving out 500, which will be more or less treated as a reduction in the amount of NCI since it was paid out to the non-controlling what? Interest. Therefore, what entry are we going to pass? The relevant entry here is to eliminate the intercompany dividend distribution and income as thus. Now, what do you do? In the books of the parents, they are going to debit the parents' profit or loss from the perspective of the group. And you are going to credit the subsidiaries element of dividend. Distribution, which is within the statement of changes in what? Equity. With how much? You are going to do that with the sum of 2.5 million. Which all figures are in thousands. Okay, sorry, not 2.5, with 80%. Remember, 80% is what the parent has, and the parent is only entitled to 80%. That is 2 million. Okay, and that will be the entry that have to be passed in this case. Now, what then happen is that in the consolidated statement of changes in equity as at 31st December 2016, what will be accounted for as dividend paid or dividend deduction from consolidated retained earnings will be solely of the dividend paid by the parent. That's number one. While the non-controlling interest will be reduced by the portion of the dividend paid to it by the subsidiary, as shown below. Shown below in this case will be 20% multiplied by the 2.5 million, which will be 500,000 naira. Okay. That is it. Now, what then do we do in this case? This has not changed. Everything here has not changed. And what do we need to do? From this point, it was 107, which we still sum up. There's no adjustments. But at dividend income, there's an adjustment, which we said we should reduce the profit of the parents by eliminating this dividend income, which means at this point, we need to carry out elimination, and we eliminate it based on analysis done here. That is 2 million. Take note of it. And the other elimination we do is that there was dividend paid if you check, the parent paid dividend of 10 million, the subsidiary paid 2.5. And based on what we have said here, we said within the consolidated statement of changes in equity as at 31st December 2016, what will be accounted for as dividend deduction from the consolidated retained earnings will be solely of the dividend paid by the parent. Solely of the dividend paid by the parent, which then means that it is only this 10,000 will deduct here as dividend paid from consolidated retained earnings. Okay, whereas the 2.5 million, 2 million has been canceled out, remaining 500,000. And we said, why the non-controlling interest will be reduced by the portion of the dividend paid to it. by the dividend paid to it by subsidiary as shown below. Now, dividend paid to it is 500,000, which is 20% of 2.5. Now, this 500,000 is what is left after deducting 2 million out of 2.5. And therefore, that will be deducted from here, which means the 500,000 is our 2.5 million, 2.5 million minus 2 million. That gives us the 500. This 500, recall, is this 500,000 here. This 10,000, recall, is the amount of dividend paid only by the parent, which is this 10,000 here. Let us take notes. Therefore, what do we have? We come back here, we say the 050 here belongs to the parent. The 25 here belongs to the parent and NCI in the proportion they share profit or loss. Now we have other adjustments. Now, what is the adjustment we have? The first adjustment we have is elimination of dividend income. And this dividend income only affects the parent from our analysis here. Only affect what? The parents. How much is it? 2 million. 2 million is a deduction from the parents. Therefore, I sum everything up. And that is how we arrive at 68 and 5,000, or 68 million and 5 million, as it is. The dividend income elimination we did here only affect the parent and not both the parent and NCI, because it's the parent's dividend income that has been eliminated, whereas the portion of the NCI has been deducted within the statement of changes in equity. Other things remain the same. The 20 million pre-acquisition reserve, subsidiary retained earnings brought forward is now 67.5 million. Parents retained earnings still remains at 120. Non-controlling interest measured at fair value was still 24. Share capital of the parents is 200. That of the Chelsea subsidiary is not required because that will have been cancelled out upon consolidation of the balance sheet. Therefore, we come here to find out that our consolidated retained earnings brought forward is that of the parent, 120, plus 80%, which has not changed, the stake of the parent in the post-acquisition retained earnings brought forward. And that is the difference between the retained earnings brought forward and the pre-acquisition profit. And also for amount of what? NCI. And that gives us our position. Nuruddin, what you did is in tandem with what we have shown here.
The difference is the treatment elimination of dividend payouts.
Yeah, but not only that, you got loss position in your computation.
Yeah, exactly.
Or that. Therefore, where does that mistake come from? Where does it come from?
I don't get.
Where does that mistake come from? What you showed us was negative profit distribution, which is not in compliance with what you have, because in one breath of it, you told us you have, what's it called? Okay, wait, I've not linked this my administrative cost. In one breath, you told us you have a profit position, but in your distribution, it is negative. Therefore, there's something wrong somewhere.
Okay. I get what's happened. It is just a symbol. I did not change the negative position that was introduced in the format to positive. because where how I formatted my own as a group is to have negative, not positive, while I
Therefore, you must also be wary of formatting all true.
By formatting that
to
was
the
faulty.
end. Yeah. Take note. This adjustment is what is reflected here now. Take notes. Any other question by anyone?
So, Mr. Muyiwa.
Yeah.
So what you just demonstrated is that once the subsidiary distributes, pays out dividend, for the parent, that dividend must be removed from the profit of the parent. But for the NCI, it has to be
removed from the value of the NCI.
At these changes in other changes,
because that is where we aggregate the value of NCI. You know, NCI is not involved in the profit or loss, because whether we have NCI or not, we consolidate the entire result of the subsidiary for the period in which we have control over the subsidiary.
Okay. Okay, thank you.
Okay. Madam Tomilola, I can't hear your voice.
Sir, I'm just trying to understand why you had to remove the dividend of the parent from the group consolidation. I can understand that thing, but that's the only.
If you go back to our discussion from the balance sheet days, you can't eat your cake and have it. You are sharing the entire profit of subsidiary, out of which dividend was paid. Can you collect dividend and collect the profit at the same time in which dividend was paid from?
Okay, sir. Okay.
You know, if you remember, we said we need to reverse that profit, as if that profit, we need to reverse dividend, because dividend is just a portion of the profit that is paid in cash. The question is, our benefit in the subsidiary goes beyond dividend. You understand? It is the entire value attributable to our involvement in the subsidiary that have to be taken into consideration, and not just a smaller component of it as a whole. Which means at every point in time, you will eliminate the dividend as an income. You will now substitute it with recognition of profit. And how do we recognize profit? By consolidating the entire result of the subsidiary, so that of all of our performance, we now have additional 20, subject to this deduction of 2 million, that accrues to the parent, which makes it 50 million to become 68 million.
Thank you very much, sir. Thank you, sir.
Which means out of the 25, the parent is entitled to 20, and of which he has collected 2 in cash, which means what is net of this is 18 that is still left in the business, which is supposed to be component of retained earnings.
Yes.
That 18 plus 50 is what gives us 68.
All right. Thank you very much, sir.
Does that make sense now?
Yes, sir. Yes, sir.
Okay, thank you. Any other question? Any other question? Okay, so that you can know how we got this 2 million. Okay, any other question? Okay, I'll give us another set of questions now, and we'll do it together. Can somebody read question 5?
Okay, let me read it. Asana acquired 80% interest in the equity of Chelsea as of January 2014, January 1st, 2014, when the retained earnings stood at 20 million. The board of Asana strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended at December 31st, 2016. Everything in thousands. Revenue, Arsenal 600,000, Chelsea 390,000. Cost of sales, Arsenal 345,000, Chelsea 201,000. Distribution costs, Arsenal 75,000, Chelsea 45,000. Administrative expenses, Arsenal 108,000, Chelsea 90,000. Dividend income, Arsenal 3,000, Chelsea nil. Income tax, Arsenal 25,000, Chelsea 29,000. Movement in reserves, retained earnings, retained profits brought forward, 120,000 Arsenal, 67,500 Chelsea. Profit for the year, 50,000 Arsenal, 25,000 Chelsea. Dividend paid interim, 10,000 Arsenal, 2,500 Chelsea. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million.
Thank you very much. Now, let's start with our adjustment here. Let's pick this information one by one. Revenue has not changed. Cost of sales have not changed. Distribution cost has not changed. Administrative has changed to 108. Dividend income has changed to 3 million. While all other things remain what? The same. Who can tell me what is critical in this question now? What are they trying to achieve with this question? And now,
okay, I think they're looking at I'm looking at the dividend paid and the dividend income for the parent and subsidiary.
Now the emphasis on this. Dividend income recognized by the parent is 3 million. Even when you check how much was paid by the subsidiary, was 2.5. Which means even if the parent owned the subsidiary 100%, he can't get more than what was paid. Therefore, the question is, where is this 3 million coming from? That's where at every point in time, you start your analysis of dividend from the perspective of the subsidiary that has paid or declared such a dividend. And which then means that what you do in that regard is to ensure that you analyze the dividend into what goes to the parent, what goes to what? NCI. Must be a function of parents and what? NCI value. Parent is 80%, NCI is 20%. The question then is 80% of 2.5 million is 2 million. And 20% of it is 500,000. Which then means that 2 million is the intercompany balance as you find it here, which is the 80% of 2.5. And that is the only amount you have to eliminate. The question then is that if you now take 2 million out, what is left is 1 million. This 1 million will be considered as dividend income from other financial asset investments, which will not be eliminated in this case. And what that means that this 1 million will be consolidated in our books. And to do that, I'll simply come back here to say there's an income which I'll come here to say dividend income of investment income, as the case may be. And how much is that? I'll link it. That is that. Therefore, and that is a position here, which means this 1 million will have to be shown in our books as part of investment what? Income. That portion is not eliminated. And it's not eliminated because of the fact that it is not that attributable to dividend received from a subsidiary. And that is a position here. Now, invariably, I'll come here and say, this is my position 50. The subsidiary is 25, which we shared. And the portion of dividend we eliminated is 2 million. You get what I'm saying now? At the end of the day, when I did at this, okay? To 10. At the end of the day, the portion eliminated is just 2 million, while 1 million is left as income from the group perspective. And that is that, as at the reporting date. Every other information remains the same. The only thing I try to prove here is that question 4 and question 5 are the same. The only difference is that not all time will the analysis of your dividend show exact amount as recognized by the parent, because the parent might also be entitled to other income in form of dividend from other investment that neither qualify as a subsidiary nor qualify as associate or a joint venture, which we'll still get to. Any other question here? Any question here? Any other question here? A narrow question, Nuruddin, Tiami, Madam Olado, any question?
No, sir, this aspect is clear from the based from the previous question to this one is clear.
Exactly.
Okay. Okay, let's look at situation where we have intercompany loans that will have created interest income in one of the parties' book and interest expense in the other party's book. How do we proceed towards elimination of intercompany interest income and interest costs? Over to one person to read this illustration as we proceed in our discussion.
Let me read it.
Okay.
So, illustration 6. Arsenal acquired 80% interest in the equity of Chelsea as at January 1st, 2014, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Equal statement for the year ended December 31st, 2016 is as follows. Arsenal, Chelsea, everything in thousands. Revenue, Arsenal 600,000, Chelsea 390,000. Cost of sales, Arsenal 345,000. Distribution cost, Arsenal 35,000, Chelsea 45,000. Administrative expenses, Arsenal 95,000, Chelsea 80,000. Investment income, Arsenal 10,000. Finance costs, Arsenal 20,000, Chelsea 10,000. Income tax, Arsenal 25,000, Chelsea 29,000. Retain any movement in reserves. Retain profit brought forward 120,000 Arsenal, 65,000 Chelsea. Profit for the year 850,000 Arsenal, 25,000 Chelsea. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. As at 1st January 2016, the parent provided a loan facility of 100 million to the subsidiary at an interest rate of 10% per annum. The loan remains outstanding as at the reporting date. The interest income is reported as an investment income in the books of the parent as shown in the financial statement for the year ended 31st December 2016. Hello? Hello?
Okay, thank you very much. Now, from this question, what can you deduce that there was intercompany loan, which will have given rise to the lender recognizing interest income and the borrower recognizing interest cost, which is finance cost. Now, if you check here, information are so clear as follows. Now, the parent provided a facility, loan facility of 100 million naira to the subsidiary at interest of 10% per annum. And this was given us at the beginning of the year. Now, what that signified is that invariably, there is 10% of 100 million naira, which will stand in at 10 million naira interest. From the parent's book, it is interest income. From the subsidiary's book, it is interest expense or finance cost. And when we check here, we can see that part of investment income of the parent is 10 million. And from the subsidiary perspective, part of the finance cost is 10 million. Upon consolidation, what do we need to do? We need to go ahead and eliminate this interest at both sides. How do you do that? Let's come back to our consolidation schedule. The information for revenue, cost of sales seems to be the same. Information for distribution cost seems to be the same, but administrative is 95 and 80. Also, we have investment income, which is also known as finance income. And this is with respect to interest, was 10 million. Now and that is what gives us our operating profits. Okay, let me try and enlarge this. Therefore, we have our finance costs, which is simply as interest costs. $20 and 10. Okay, I then have my profits before taxes. Okay, other things remain the same. Therefore, we've done this 75, 54. Therefore, we've populated this. Okay. Therefore, in attempting solving the problem, we now have to eliminate this. How do you eliminate this accounting entry? In the books of the parent that has recognized interest income, you will debit it in order to eliminate. You debit in parent's book the investment income. And you credit in subsidiary's book the finance costs. With how much? With the sum of 10 million naira. The 10 million is the product of the 10% interest and 10 million naira, 100 million naira loan. That should give us since all figures are in thousands, let me just remove 1, 2, 3. Okay, that's how we arrive at this. Take note of that once again. Therefore, what do? We come here, we eliminate the 10 million by debit to the finance income for the parents, and we come to the finance cost with credit with 10 million. At the end of the day, what have we done? What have we done is that at this point, we have eliminated the interest income, and we have eliminated this aspect of the interest expense, leaving out the 20,000 or the 20 million aspect. At the end of the day, what we have simply done is to adjust for this element and this element. Okay. And that is it. Which then means that the elimination we're going to do here, in order to arrive at this, is going to be 2 items. Elimination of investment income and elimination of finance costs. And that's one in the is in and out. This is going out, and this is coming in. At the end of the day, what do we have? $70 and $5. All other information remain the same. And this is it. Okay, now if you come back here, you'll find it out here that our investment income has been eliminated, but I can show you what it is. Anyone that is left will be attributable to others other than those eliminated, which in this case, we don't have any portion eliminated. And our finance cost that is left will only be finance costs other than that attributable to intercompany loan. And that is with respect to what is left after the elimination, 20. And that is what we get at the end of the day. Income tax, and that is that. At the end of the day, these are consolidated statement of profit or loss and other comprehensive income, giving our gross revenue for the group to be 990 million. Our cost of sales is 546 million. Thereby, our group profit, gross profit, is 444 million. Our distribution and administrative expenses is 295 million. Investment income is nil off, since all of it is attributable to intercompany transaction. Our operating profit for the group was 149 million. Our finance cost for the group was 20 million, thereby having the profit before tax of 129 million for the group. The income tax of the group is 54 million. Therefore, profit for the year from the group perspective is 75 million. And this is attributable to 70 million for the parent and 5 million for the non-controlling interest. Okay, that is that. Once again, you can see our statement of changes in equity. And here, there's no dividend in this case, therefore no transaction within equity. Any other question? Our profit now is 65. This has changed. Take note of it. Okay. Every other information remain what? The same. Subsidiary retained earnings brought forward is 65 million. Any other question?
Okay, I just want to ask that In the statement of changes in equity, once there is a payment of dividend to the owners of the parents, there is always this, there's a reduction of the retained earning by that amount. But what of the dividend that was paid to the non-controlling interest? It was paid.
Yeah, that's why we reduce it here now. The same way you have reduced the not paid by parent is a portion of the NCI that we have also reduced there.
Okay. Thank you. Okay.
Remember, we did an analysis there. Okay.
Yes.
There's 500,000 due. If you check all this analysis there, that's what we've done. And when you read this, it's more or less explicit telling us what to do at that point in time. Does that make sense now?
Yes, exactly. So that means, but what we just did now is the parent that gave the loan facility to the subsidiary. But if it has been the reverse, the treatment will have been different. I think so.
Maybe.
Okay.
Yeah. Thank you. Any other question?
Thank you, Mr. Muyo. In addition to that question, still on that loan stuff, I want to know the treatments of the principal elements of that loan, given that the parents extend loan to the subsidiary. Will there be elimination of the principal sum in the statement of financial position too?
I think we did that before. If you go back to what we have done in the balance sheets, it's part of the examples we did about eliminating any form of balance, whether receivable, payable, loans, or whatever balance it is.
It's true. Yes. It's
true. This aspect is the profit or loss aspect.
I get it clearly.
Therefore, we can't eliminate the principal amount inside profit or loss because it's not sitting there.
I know.
Okay.
Thank you.
Yeah. Now, let us now look at bringing in bigger adjustments or common adjustments, which is intercompany sale of goods. What would we do if we find ourselves in that situation? Okay, these are the common adjustments that you find in business combination. Okay, this is a question. And we're going to look at it from different perspectives. Is it a downstream transaction? Is it an upstream transaction? Remember, a downstream transaction is where sales is initiated by the parent to the subsidiary, while an upstream transaction is the reverse, where the subsidiary initiates a sales transaction to the parent. And this has consequence in the elimination of intercompany balance or transactions. Okay, I want somebody to read this question and let us start a new journey, which is very key in the whole process of consolidation. Okay, who will read this question? Illustration 7.
Okay, let me read it. Illustration 7, downstream transaction, sale of goods by the parent to the subsidiary. Arsenal acquired 80% interest in the equity of Chelsea as of January 1st, 2014, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. Arsenal on the left and Chelsea by the right. Revenue, Arsenal 600,000, Chelsea 390,000. Cost of sales, Arsenal 345,000, Chelsea 201,000. Distribution cost. Arsenal 75,000, Chelsea 45,000. Administrative expenses. Arsenal 105,000, Chelsea 90,000. Income tax 25,000, Arsenal 29,000, Chelsea. Movement in reserves. Retained profits brought forward. Arsenal 120,000, Chelsea 65,000. Profit for the year. Arsenal 50,000, Chelsea 25,000. Additional information. Arsenal sold goods to Chelsea for 50 million when it actually cost the parent company 40 million. Unfortunately, at the year end, included in the inventory of Chelsea PLC is the whole inventory sold by Arsenal PLC. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million.
Okay, thank you very much. Okay, now let's pick it one by one. The first thing that is critical to us is to confirm this data, that it has changed or it has not changed. This remains the same up to this point. I think it's all the same, yeah? Now, the stake of Arsenal and Chelsea is still 80%, and retained earnings as at acquisition is still 20 million. Now, prior to looking at additional information, which is the most critical aspect of it, the Arsenal share capital remains the same, Chelsea share capital remains the same, and NCI is being measured at fair value, 24 million. That means all the information here remains the same, except for this additional information, which I'm going to highlight. Additional information says that Arsenal sold goods to Chelsea for 50 million, when it actually cost the parent company 40 million. Unfortunately, as at the year end, included in the inventory of Chelsea PLC is the old inventory sold by Arsenal PLC. Therefore, who can interpret this question before I proceed? Who can interpret the question?
Okay, what that question is saying is that one, the goods sold to the subsidiary, it has not been sold by the subsidiary. Then two, the parent has recognized as part of its own profits that 10 million naira, whereas the goods is still within the group.
Who else? Who else?
I think what the question is trying to say is that the goods that cost Arsenal 40 million was sold to Chelsea at a rate of 50 million, meaning that there is 10 million profit elements in the transaction by Arsenal to Chelsea. Meanwhile, all the items of inventory were not sold by Chelsea, and it formed part of the inventory reported in the book of Chelsea.
Okay, let's pick it over. Okay.
Let me just add this. I think it's a function of revenue and cost of sales. So there's a 50 million revenue within the group and also a cost of sales of 40 million. That is the angle I'm looking at it from because of the income statement.
Now, elimination of intercompany sales transaction is going to trigger about 3 adjustments, if any. Okay, and we're going to pick them one by one. And for the first time, we are going to model them. And going forward, our life will be made easier. Now, the first adjustment, which is A, is eliminate sales, intercompany sales revenue. As thus. Now, the value of the sales is given at 50 million. Therefore, what do we do? This is the amount of intercompany sales that we have to eliminate. And we'll do that by debit our sales revenue. Who made sales here? Which means the parents. And credit the inventory. Remember, the issue we had with respect to intercompany transaction, but I'll leave it like that, okay? And let me say, in this case, the cost of sales of the subsidiaries cost of sales will be eliminated. Let me put it at inventory level so that I simplify it in a better way for your understanding. Okay, this is as if the sales never occurred. And what will I do with the value of the sales? What's the value of the sales? 50 million, but all figures in thousands. That's that. Now, the second adjustment is to eliminate intercompany cost of sales. The first one was to eliminate intercompany sales revenue. Okay. And what do we do? In this case, we are going to debit the subsidiaries inventory, and you are going to credit the parents. Sorry, the subsidiaries cost of sales. Now, at the end of the day, you do that with what? With what we call intercompany cost of sales adjustments. And intercompany cost of sales adjustments is as follows. It is the difference between intercompany sales revenue, which is the 50 million, less unrealized profits on inventory or on sold goods. Now the question then is, what is our unrealized profit? Our unrealized profit is similar to the way we determine it before now. Now the unrealized profit on sold goods, or simply put on inventory, is the knowledge we had in our days when we are doing the balance sheet, which is the percentage of unsold goods multiplied by the profit on sales. On sales, on intercompany sales. Okay. Now, this is the formula that we use then. Okay. Alternatively, we can also use formula based on information available. And what is that? The markup multiplied by the cost of unsold goods or inventory, if you have it. Or if you are not given the markup, we have the margin. It will be the margin multiplied by the value of unsold goods. The value of unsold goods is like the selling price of the unsold goods or inventory. Margin okay. These are various formulas that we can use depending on the information provided. In this question, what is information provided? We are provided with the cost of the item, which then means that in this case, in our case or situation as it is now, in this question, our profits on sales, on intercompany sales, is as thus. It is the difference between my intercompany sales and the cost of the goods. What's the cost of the goods? the cost of the goods in this case is 40. It costs the parent 40 million, what is sold for 50 million. Therefore, you subtract 40 million from it, which means this is the profits on sales. Is this profit that will find a percentage on, which then means in that case, my unrealized profits, hence the unrealized profit is as thus. I repeat the formula so that we can copy the formula there and can make use of it, which means in that case, it is unrealized profits. Percentage of unrealized profit is 100% because 100% of the entire goods were unsold. Because we are told that all of the goods, all, the word all included in inventory is equivalent of 100 what? %. Therefore, 100% of the 10 million, which is profit on intercompany sales, will give us our value, which is what's our value? Our value will now be 100% of 10 million. And that will also be 10 million in this case. Take note of that. Now, 10 million is our unrealized profit because the whole of the goods were still in the hands of the subsidiary, which were not sold by it as at the reporting what date. Okay. That is that. Take note of it. Okay, now we said our intercompany cost of sales would be to eliminate this. And once you eliminate this, what do you have? You now have what we call you eliminate this, or you deduct, you now have 40 million. This 40 million will represent our intercompany cost of sales adjustment. Somebody will say, how does this 40 million differ from this 40 million? They look as if they are the same, but they are not the same. Where you are going to know is by the time you find out that not all of the goods are unsold at the end of the day. You will now find out that this cost of sales or cost of goods sold is not the same thing as our intercompany cost of sales adjustment. Let me put it as intercompany cost of sales what? Adjustments. Okay. Now, what then do we do? You find out that at the end of the day, what you are trying to achieve is the elimination of unrealized profit to the tune of 10 million. And see how we're going to do that. Now, the intercompany revenue will be eliminated under the group adjustment. We'll link it to our revenue at this point. And once you do that, what it's trying to tell us is that from the group perspective, our revenue should not be more than 940 million because there's a duplication of revenue. Part of this 600 million is this 50 million. And part of this 390 million is still that same 50 million because this person sold to this person to recognize revenue. The same amount this person sold to third party to recognize that amount. Therefore, we need to eliminate double counting. Second, we need to eliminate the cost of goods sold that's also double counted in relation to this. And that is based on the intercompany cost of sales adjustments, not necessarily the cost of sales from the initial seller. And that is why what matters is this intercompany cost of sales adjustment, not necessarily this 40. And we're going to see it from another illustration, why this 40 and this 40 are not necessarily the same. Once I do that, I have this. Invariably, what we have done is that our cost of sales is reduced by 40. Invariably, this 10 is now the unrealized profit. This 10 is the unrealized profit that we try to eliminate, which is this. And it's not the same thing as this 10, which we are going to see as we move on. This 10 is what we have here, if you cross it. Let me find a line that I can insert. Okay, I'll get it here from this shape. Okay. Let me link this. I'll link it to this, which means this is flowing from here. Therefore, this is flowing from here to here. Okay, which means this 10 is what we are eventually eliminating at this point here. Just take note of it. Any question before I proceed? Any question before I proceed?
Mr. Muyiwa,
Yes, sir.
I was thinking that by the time we eliminate the revenue of 50,000 or 50 million and the cost of sales of 40 million,
yeah,
automatically we have eliminated the unrealized profit.
Yeah, that's what we have done now. That's what it is.
Okay.
Is that not what you are seeing?
I'm seeing what it's in that. I'm looking at it. Okay.
No, this is the original account now. These first two are the original accounts. Don't mix it up. These are the original account. This is elimination at Group.
Okay. Okay.
Have you seen it clearly now?
Okay.
Yes, don't mix it up. This is everything you find here are from the account itself. Let me try and create a drawing here so that probably you can understand what we are trying to do. Let me try and create a drawing here so that you don't mix it up. Everything here, the way we have it, in our account from the individual financial statement, both the parent separate financial statement and the subsidiary financial statement. Do you get it now? This is where our own work starts from, adjustment to produce the group. You don't touch what has already been done. Anything you want to adjust, you pass it to an adjustment.
Okay.
Any question again? Any question? Nuruddin.
No questions, sir.
Okay. Now let's come back here. The adjustment we now have in this case is unrealized what? Profits. Unrealized profits on inventory. And that unrealized profit on inventory, we ask ourselves, who made the profit? Who made the profit?
Parents.
Why is it the parent that made the profit?
Because parents sold to subsidiary.
Yes, the parent is the seller, if you remember. And in that case, the parent has made that profit, which we have deemed unrealized. In that case, the profit will only be eliminated to the extent of the parent, which means I'll come here, since the unrealized profit is attributed to transaction, to sales transaction initiated by the parents. Hence, the all of the unrealized profits will be deducted from the profits of the parents. And NCI is not affected. You can refer to our discussion in earlier classes when we did the consolidated statement of financial position. Therefore, take note of this. Take note of it. Technical notes. Therefore, in that case, when we come to this adjustment, it is only the parent that will be affected and not the parent and NCI. Therefore, the whole of these adjustments is solely to the parents. And when we come here, we sum everything up. Any question? Now you can see how we attribute the profits of 65 million to the parent and NCI in ratio 60 million to 5 million. And that is the same thing we showed there in our accounts. Any question? Any question? Now, for that same question, what if is the subsidiary that sold to the parent? What will have happened? Who can tell me what will have happened?
That is downstream transaction, and the adjustment.
Can you start again? What do you say?
I said, if it is subsidiary that sold to the parent, it will be treated as a downstream intercompany transactions.
Are you sure?
And
we just treated, the one we treated now is...
Sorry, upstream.
Okay.
It will be treated as upstream intercompany transactions. And the implication is that the portion of unrealized profits will be adjusted against the subsidiary and the NCI.
Okay, we'll get to that. But before we get to that, I want to replicate this same question, but it will be twisted in a manner that will depict whether you really understand some of those commentaries and remarks I've made in the course of solving this question. Now I'm bringing another question to us now, which I'll demand you guys to tell me what would be the difference between this question and the one we just finished. I'm uploading the question now. I want someone to read the question and provide the guidance to solving this question. Over to you.
Okay, illustration 8. A downstream transaction sales of goods by the parent to the subsidiary. ACTA acquired 80% interest in the equity of Chelsea as at January 1st, 2014, when the retained earnings stood at 20 million. The board of ASNA strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of parent as at December 31st, 2016. Income statement for the year ended 31st December 2016. ASNA Chelsea, all figures in thousand. Revenue 600,000 for ASNA, 390,000 for Chelsea. Cost of sales 345,000 for ASNA and 201,000 for Chelsea. Gross profits 255,000 for ASNA, 189,000 for Chelsea. Distribution costs 75,000 for ASNA
and 45,000 for jobs. Administrative expenses, 105,000 for ASNA and 90,000 for jobs. Profit before tax, 75,000 for ASNA and 54,000 for jobs. Income tax, 25,000 for ASNA and 29,000 for jobs. Profit for the year, 50,000 for ASNA and 25,000 for jobs. Movement and receipts, retain earning profit brought forward, 120 for ASNA, 65,000 for jobs. Profit for the year, 50,000 for ASNA and 25,000 for jobs. Retain profits carried forward, 170,000 for ASNA and 90,000 for jobs. Additional information. ASNA sold goods to Chelsea for 50 million when it actually cost the parent company 40 million. As at the year end, included in the inventory of Chelsea PLC is 40% of the inventory sold by ASNA PLC. Required, prepare the consolidated profit or loss and the consolidated statement of change in equity, given that the share capital of ASNA stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira.
Now, this is where the difference lies. What I have highlighted in yellow and red, who can interpret what it is?
Interest charge is 40% of the interest rate. As of the inventory of jobs.
Okay, I think there is a 40%. There's a 40% intercompany cost of sales that would have to be 40% of the total value of the goods that was sold from the subsidiary to the parent. 40% of the amount in revenue and 40% will have to be eliminated. Because there is an unrealized profit of about 40% of the 10 million profit on it.
Okay, thank you very much. Now, what is this question is so simple. Can somebody read this sentence again? as
at the year end, included in this inventory of Chelsea PLC is 40% of the inventory sold by Arsenal PLC.
included in inventory means part of what was not sold by Chelsea is 40% of the goods that was sold by Arsenal to it, or that was bought from Arsenal. Now, which means, unlike in the first question we did, they said the old was included in inventory. The old means that he was unable to sell anything. But in this question, we're told that it's only 40% he was unable to sell, because anything included in inventory means it was unsold, which means he only ventured into selling to the tune of 60%. Therefore, what do we need to do here? Which means instead of us coming to recognize 100% as unsold, what we are going to recognize in this case is what? 40% unsold. Are you getting it now? 40% what? Unsold. Which then means that 40% unsold, our changes from 100% to 40%. And you can now find out that the cost of sales adjustment is not the same thing as our cost of goods sold. Can you see it? What I was telling you the other time. This 46, which is intercompany cost of sales adjustment, is not the same as our normal cost of sales, which is 40 million. No. It is the value that will allow us to successfully eliminate intercompany unrealized profits adjustment, or what I will simply call unrealized profit adjustment on inventory. Which means your intercompany cost of sales adjustment at every point in time will be the difference between the intercompany sales revenue and the unrealized profits. And the unrealized profit is only attributed to the portion of the profit on the entire transaction that is unrealized, which is being included in the amount of goods that remain unsold as at the reporting date. Now, but be wary of the examiner. Information can be twisted such that what they give you is a portion sold, which means they might tell you that as at the end of the year, it was observed that 60% of the goods sold by Arsenal to Chelsea has been sold by Chelsea to its customers or to third parties, which means in that case, 60% given to you relates to portions sold, whereas to now determine portions unsold is the difference between that 60% and 100%. But the most important thing we need to take note of is that unrealized profit relates to the portion of the profit that is still inherent or that is embedded in the inventory within the group. And if you want to also more or less understand it further, we'll go back to what we have done under the group adjustment when we are consolidating the balance sheet of the parent with the subsidiary. Take note again, unrealized profit is the percentage of unsold goods times the profit made on intercompany sales. And in this case, the percentage unsold is 40%, because 60% has been sold to customers outside the group. Now, on that premise, see how that affects our consolidation schedule. Our consolidation schedule, as you can see it here, is 50 was eliminated as intercompany sales, 46 and not 40 was eliminated as intercompany cost of sales adjustment, such that what was eventually eliminated as unrealized profit is this 4 million. which you can see here, this 4 million there. Eventually, what has happened? The entire 4 million is what was eliminated against the profit of the parent, because this 4 million was already sitting in this 50 million, which we have considered that is no longer realized. And on that premise, we produce our consolidated statement of profit or loss and other comprehensive income. Any question? Any question on this? Which means this has exposed us to two things. One, where all of the goods are unsold and where the adjustments for intercompany cost of sales look similar or the same with the cost of sales of the selling party. And the second one is where not all of the goods are unsold. Certain portion of the goods remain unsold, and that portion will make it so glaring to us that the cost of sales adjustment is not exactly the same as the cost of sales to the selling party. That is it. Now, let me show you a trick. Let us imagine that all of the goods were sold by the subsidiary as at the end of the year. What will happen is that in this case, percentage unsold will be 0%. And once it is 0%, what happened is that there won't be any unrealized profits to be eliminated. Thereby, the intercompany cost of sales, which you can see here, intercompany cost of sales, adjustments, and intercompany sales revenue will be the same. And there is no unrealized profit to be adjusted. And when you now go to our consolidation schedule, you find out that there's no unrealized profit to be adjusted. Everything shows that the profit still remains the same and nothing to be deducted against the parent. And eventually, this is what you get as your consolidated statement of profit or loss. Which means this has shown you all possible scenarios of having 100% on sold item at the end of the year, having less than 100% on sold item at the end of the year, and having nothing left on sold as at the end of the year. The various implications are what you can see here. Any other question? Any other question?
The portion of unrealized profits, why is it attributed to only the parent? I thought it was supposed to be parent and the parent and the NCI.
That means you didn't follow us from beginning. Who sold to who?
I think it's
who is the selling party?
Subsidiary sold to parent.
Where did you see that?
Oh, sorry. I thought it is upstream. We did downstream.
We are still at downstream.
Oh, we are still at downstream. Okay.
Yeah, I only told you that. Let me give you an additional scenario where it is not all of those items remain unsold. That means you didn't follow us.
Okay. Oh, sorry for that. I thought it was upstream.
Oh, no. That means
I thought when it was when Basu was answering that question, he said downstream. No, you're not correcting that it's upstream.
No. I gave a scenario that what if the subsidiary sold? Will the treatment be the same?
Okay.
And that was even before this question. And he read this question. That means probably you were not listening to the question when he read it. Because the question was so clear that Arsenal, which is the parent, sold to Chelsea.
Okay, downstream, yes.
The selling party, which is the parent, is the person that made the profit. And we are saying that part of that profit, which make up this 50 million, has not been realized. Therefore, take it out from it. That's what we're saying.
Yes. But in order to add one more thing, Mr. Muyiwa, in practice, this thing is not so straightforward, because normally let's say a parent that sells the same product as the subsidiary, haven't sold goods to the subsidiary, you may not actually know the portion that is unsold. If you sell goods to the subsidiary, and the subsidiary also probably buys from, if it's raw material or something, buys from outside. And so it will be difficult for you to differentiate which portion has been sold.
You will know, because remember that the subsidiary has inventory management system that keep track of every inventory that comes in batches or in lots. And it knows where it's buying from, because everything is kept in different bins, and it can be able to track it effectively.
Okay. Okay. Okay.
Please take note of that.
Okay.
Okay, now let's now look at the upstream. It seems you are interested much more in the upstream. We'll look at the upstream now with an illustration, and you'll be the one to take us through that. Okay, you'll be the one to take us through this one. Can you proceed? Enaro, we are with you. Hello, we can't hear you. Enaro. Okay, it seems his network is poor. Okay, Nuruddin, can you proceed?
Okay, illustration 9. An upstream transaction, sales of goods by the subsidiary to the parent. ACTI acquired 80% interest in the equity of Chelsea as of January 1st, 2014, when the retained earnings stood at 20 million. The board of ACTI strictly wants it to comply with the requirements of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at 31st December 2016. Income statement for the year ended 31st December 2016. ASNA, Chelsea, all figures in thousand. Revenue, 600,000 for ASNA, 390,000 for Chelsea. Cost of sales, 345,000 for ASNA, 201,000 for Chelsea. Gross profit, 255,000 for ASNA, 489,000 for Chelsea. Distribution costs, 75,000 for ASNA, 45,000 for Chelsea. Administrative expenses, 105,000 for ASNA, 90,000 for Chelsea. Profit before tax, 75,000 for ASNA and 54,000 for Chelsea. Income tax, 25,000 for ASNA and 29,000 for Chelsea. Profit for the year, 50,000 for ASNA and 25,000 for Chelsea. Movement in receipts,
Retained profits brought forward 120,000 for Asna, 65,000 for Chelsea. Profit for the year 50,000 for Asna and 25,000 for Chelsea. Retained profits carried forward 170,000 for Asna and 90,000 for Chelsea. Additional information. Chelsea sold goods to Asna for 50 million when it actually cost the parent company 40,000. As at the year end, included in the inventory of Asna PLC is 40,000 of the inventory sold by Chelsea PLC. Required. Prepare the consolidated of profit or loss and the consolidated statement of changes in equity, given that the share capital of Asna stood at 200 million and that of Chelsea amounted to 100 million. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million. Hello, sir.
Okay, thank you. Now,
yeah, there is something I observe in this additional information.
Okay, what is it?
Okay, Chelsea sold goods to Asna for 50 million when it actually cost the, I think it should be
No, it's not the parent. In this case, it's not the parent, it cost the subsidiary.
Exactly.
Okay, let me try and when it costs the subsidiary. Okay, is that okay, sir?
Very correct.
Okay. Now, when you look at this question, the only point we need to focus on is this 40%. And of the fact that Chelsea sold goods. Now, which means, unlike the other question, reverse is the case here, where the person that made the profits or made the sales was the subsidiary, and the profit is already seated in these profits. And what was the profit seated there? The profit seated there is this 4 million. And we'll have to now change our narrative here to say, since the unrealized profits is attributed to sales transaction initiated by the subsidiary in this case. Hence, the whole of the unrealized profits, which is not the whole now, the unrealized profit will be deducted from the profit of the parents, the percentage of the parents, which is 80% in this case, and deducted from the NCI, the percentage of the NCI, which in this case is 20%. which means in that case, what you have to do is that you share it 20 and 80% between the parent and what? NCI. Therefore, I'll come here, it will be ratio 80 to 20, which means I'll come here, I'll take the products, that is 80%, and this. That means 3.2 affect the parents. And I'll take 20%. Which is this, to affect the NCI. In that case, what do we have? We have 80% affect parent and 20% affect NCI. And that's just the difference. This arena is just the difference between the solution and the first solution, which speaks to the fact of the difference between upstream and downstream transaction. Any question on that?
No. It's but that, when you asked me to read that time, I think my network went down.
Yes, we suspected. That we suspected. Okay. That is it. And from the group perspective, this is what we have. And you can see, let me try and copy the solution of the other one so that I can see it side by side and see what the position looks like. If you put it side by side, what do you have? You can see what you have here. Nothing will change in the body of the consolidation because it's a mere aggregation. Where the issue lies is between your profit attribution. You could see this is 6,800, this is 4,200, but this is 6,000, this is 5,000. The difference is how the elimination of unrealized profit affects either the parent alone or the combination of the parent and the NCI. Okay, that is that. Any other question? Okay. Now let's look at, okay, can we have a break? And when we come back from the break, we'll look at the last set of adjustments, which is adjustment relating to sale or transfer of items of property, plant, and equipment within the group. Okay, we'll go on about 10 minutes or 15 minutes break. We'll reconvene 4:10.
4:15.
We'll convene 4:10. That's 20 minutes break. Okay, we'll look at a question. Okay, hold on, no, we'll look at a question that more or less relate to intercompany transfer or sale of an asset. And for example, this asset is a depreciable asset. what kind of adjustment will be triggered if an asset has been disposed of within the group during the year, and what effect would that have on depreciation? Okay, over to you, Nodem.
Yeah, illustration 10. A downstream transaction, sales of plants by the parent or a subsidiary. ACTI acquired 80% interest in the equity of Chelsea as at 1st of January 2014, when the retained earnings stood at 20 million. The board of ACTI strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at 31st December 2016. Income statement for the year ended 31st December 2016. ASNA, Chelsea, all figures in thousand. Revenues, 600,000 for ASNA, 390,000 for Chelsea. Cost of sales, 345,000 for ASNA and 201,000 for Chelsea. Gross profit, 255,000 for ASNA and 189,000 for Chelsea. Distribution costs, 75,000 naira for ASNA and 45,000 naira for Chelsea. Administrative expenses, 115,000 naira for ASNA and 90,000 for Chelsea. Other income, profits on disposal of plants, 10,000 naira for ASNA and nil for Chelsea. Profits before tax, 75,000 naira for ASNA and 54,000 naira for Chelsea. Income tax, 25,000 naira for ASNA and 29,000 naira for Chelsea. Profits for the year, 50,000 naira for ASNA and 25,000 naira for Chelsea. Movements and reserves. Retained profits brought forward, 120,000 naira for ASNA and 65,000 naira for Chelsea. Profit for the year, 50,000 naira for ASNA and 25,000 naira for Chelsea. Retained profits carried forward, 170,000 naira for ASNA and 90,000 for Chelsea. ASNA sold a plant to Chelsea for 50 million when its carrying amount stood at 40 million as at the transfer date being 1st of January 2016. As at the transfer date, the plant has a remaining useful life of 5 years and the pattern of consumption has since not changed. It is the company depreciation policy to adopt a straight line method of depreciation required. Prepare the consolidated statement of profit or loss and consolidated statement of changes in equity, given that the share capital of ASNA stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira.
Okay, thank you very much. Now, what can you deduce from this question? What you can deduce from this question is that there is an intercompany sale of goods, which means, yeah, I need to more or less recognize such a transaction. Group adjustments regarding intercompany transfer or sale. Intercompany transfer or sale of PPE. That's property, plant, and equipment. Now we need to understand who sold to who. Who sold to who? ASNA sold the parent sold to Chelsea, the subsidiary. And we can characterize that as a downstream transaction. Okay, the first adjustment is to eliminate profit on disposal of assets within the group in the current year. This adjustment is only required if it's only required in our consolidated profit or loss if the disposal took place in that year. Otherwise, if it took place in earlier years, such adjustment will have been passed last year or previous year. Okay, but in this case, the disposal took place first day of January during the current year, which means that profit will have been embedded, and which is what was shown here as other income. Okay, that profit has to be eliminated from that book because you can't make profit out of yourself, given that the parent and subsidiary are of a single group. Therefore, what do we do? We first of all identify profits on disposal as thus. And having identified that, it will be the difference between the transfer price on disposal of plants and the carrying amount of the plant at disposal. What was the price of the asset upon disposal? The plant was sold for 50 million. And the carrying amount, as at the time it was sold, was 40 million. Therefore, profits on disposal, which is now deemed unrealized profit, is how much? It's 10 million. Okay. That's 10 million. Okay, let's take note of that. And these have to be eliminated as thus. Accounting entry. You debit the other income, that is profits on disposal of assets in the books of the parent, because the parent is the seller, and credit. the subsidiaries plants. That is the entry. The pass to recognize that. Now, that is the first issue. The second issue is now the subsidiary that bought this asset will have depreciated this asset on the basis of 50 and not on the basis of 40, thereby resulting in excess depreciation over time, which you have to now pass an adjustment on, which means the subsidiary has depreciated the asset more than what is supposed to, given that it has only taken into cognizance the transfer price and not the carrying amount. And this is appropriate from the angle of the subsidiary, given that it's a separate legal entity. But from the group perspective, it won't be considered to be separate. It's an inherent part or a component part of a whole, which is the parent under the group structure. In that case, we identify what amount of depreciation will have been charged if it's based on 40 million, as opposed to based on 50 million. The difference between the depreciation charge and the depreciation expected to have been charged from the group perspective will constitute our excess depreciation adjustment. Therefore, excess depreciation adjustment on the plant. And that will be determined from this approach. You compare depreciation charge based on transfer price, and that is the assets in question was transferred on 1st of January 2016, and it has 5 years to go as the remaining life. And straight line depreciation method is to be adopted. It means that asset which was bought for 50 million will be depreciated over 5 years. Okay, and this is the current year. We are only taking 1 year in full for that, which means the current year, which is the first year of depreciation, given that the asset was brought in at the beginning of the year, will attract full year depreciation. And this full year depreciation is 50 million divided by 5 years. And that should give me 50 million divided by 5 years. I take the product out. That is 10 million per year. Now, because it's profit or loss, your adjustment will be restricted to 1 year, not like balance sheet where you do cumulative. I'll now compare this with my depreciation. Expected to be charged based on carrying amount. Let me give this different color and this different color. In that case, and that is 40 million divided by 5. That's 8 million. The difference between these two, which is 2 million, will give me my adjustment for excess depreciation. For the current year. It's a full year. If it's not full year, you prorate your depreciation. Full year. Therefore, what entry will I pass? The entry is to reverse that depreciation. Thereby, to reverse the depreciation, which is in excess, I'm going to debit subsidiaries plant, which is the asset. The plant is an asset. And I'm going to credit the subsidiaries profit or loss, that is the administrative expenses. If depreciation is included within administrative, or cost of sales, if it's included within cost of sales, or whatever category of expense line it is being reported. But in this case, we are not given any information whether the depreciation is included in cost of sales or administrative expenses. But because it is a tradition, except otherwise, or if it's for manufacturing, that the depreciation of assets are majorly reported within administrative expenses. And that's what we've done here. Now, what is the implication of this? Let us go back to our consolidation schedule. What has changed? Okay, the following has changed, which I have to take into cognizance. Okay. Let me shift this down. Okay. Other income. Other income, this 115, this 90, other income is 10. This is 0. Okay. The other item we have here, okay, that's all. Let me shift it once. Okay. Okay. Now let's pick the adjustment one by one. Now the adjustment here is to eliminate unrealized profits. The aspect that affects profit or loss is other income, which have to be reduced by 10 million. Therefore, I'll come here, that told to debit it. And when you come to the entry here, can you see? They are told to debit it. And upon doing that, I have this. Okay, administrative expenses, we are told to credit it to the level of excess depreciation. And that is it here. Other items affect balance sheet, and we are not preparing balance sheet, therefore it won't surface in this case. Therefore, I sum everything to obtain a total position. Therefore, what do I have? Therefore, this is my consolidation schedule, where I've eliminated the excess depreciation. If you remember, let me borrow a leaf from here. This arrow, let me copy it. Okay, let me show this arrow. This arrow shows where it's coming from. This 2000 is coming from here. Okay, I'll create another arrow. This other arrow shows where this 10,000 is coming from. Okay, that is that for your own understanding. Now, having done that, the next information is this my adjustment. There are two adjustments. Okay, what are the adjustments? One is elimination of unrealized profits on disposal. And two, excess depreciation adjustments on plants. These are the two adjustments, and I'm going to bring them in. Now, the first one, elimination of profits. Who made the profit? The seller. NCI will not be affected because the seller in this case is the parent, which is a downstream transaction. Therefore, similar to what we have done before, this profit is only of the parent. Therefore, the parent will be the one to bear the brunt of the reversal. In that case, what will I do is to deduct it from the parent pool, which is what you have here. NCI is not affected, but the profit of the subsidiary has been over-depreciated, has been over-deducted, which means has been understated because of the excess amount of depreciation charge. And therefore, we have to reverse that 2 million that is charged in excess, which will increase the profit of the subsidiary. And therefore, the subsidiary profit is due to the shareholders, which is made up of the parent and NCI, which that means that in that light, they have to share it in ratio 20, 80, 20. Therefore, I'll come here. Let me copy this as part of my technical notes. Okay. Let me put my technical note here. One, since the unrealized profits are attributable to the sales transaction initiated by the parent. Okay, let me pick the one I have here. Since the unrealized profits are attributable to the sale transaction, sale of asset transaction initiated by the parent, hence the all unrealized profit will be deducted from profit of the parent, and NCI is not affected. Two, the excess depreciation adjustment, since it affects the subsidiary's profits, being the buyer and the user of the assets subsequent to its purchase. The adjustments will impact both the parent and the NCI in the proportion they share subsidiaries' profits or loss. Therefore, in this case, what will happen? Hence, the excess depreciation adjustment will be added to the profit of the parent, percentage of parent 80%, and to the NCI, percentage of NCI 20%. Okay. I want somebody to reiterate what I've written and try to confirm whether you understand it or not. I'm coming. Okay. Now, who can read this? Who can read the technical notes?
Let me read it. Okay. Since the unrealized profit is attributed to sale of assets transactions initiated by the parent. Hence, the whole of the unrealized profit will be deducted from the profit of the parent, and NCI is now affected. 2. The excess depreciation adjustment, since it affects the subsidiary being the buyer and the user of the assets subsequent to its purchase. The adjustment will impact both the parent and the NCI in the proportion they share subsidiaries' profit or loss. Hence, the excess depreciation adjustment will be added to the profit of the parent, the percentage of the parent, which is 80%, and the NCI, and the NCI percentage, which is 20%.
Thank you very much. Thank you very much. Now we are going to demonstrate that understanding now. How do we demonstrate it? It's to say that the portion we are to add is the percentage of the parent against the excess depreciation adjustment, which shows that 1.6 is what is due to the parent. And the balance, which represents 20%, will be due to the non-controlling interest. I'll copy the formula and I'll change it from 80% to 20%. And this is my 20%, and that's 400. All things being equal, I'll sum up all of this. Any question? And once I've done that, I've been able to attribute this 67 million to 61,600 and 5,400. And if you want to see it, I can just create a total column here, which is not necessary. But if it's going to enhance your understanding, I'll just create a total column here, which will just be a summation. It will be sum of all what I have I'll sum up everything. Which is that 67. But this section is not necessary. Okay? This is not necessary, but if you deem it fit that you want to make reference to it, there's no problem to make reference to it. Okay? That is to show us that we've appropriately attribute the profit. Therefore, let's go back here. Now, because we have more or less included some lines, this is not aligning. My distribution cost, the other one is other income. Okay, what is my administrative cost again? My administrative cost is 203 after adjustments. My other income if any, is 0 because the adjustment has totally eliminated. Okay, and that's how we got our. That's how we got our 67 million, which has now been attributed as 61,605.4. Remember, what have we done? What we have done is this. Unrealized profits relating to disposal of assets and asset depreciation adjustments. Those two are adjustments that we obtain here, which you can see from your understanding of what we've done so far. Elimination of profit on disposal of assets within the group is based on the difference between the transfer price of the asset and the current amount of the assets. And this is only required to be adjusted for in the current year if the disposal takes place in current year. But for the asset depreciation adjustment, it will be required provided the asset is still being in use and being depreciated. I need to look for the difference between the depreciation charge based on transfer price and depreciation expected to be charged based on carrying amounts. Okay, another approach to doing this is that this same asset depreciation, I can get it from a simpler approach. And let me try and show you a simpler approach to it. Let me try and show you a simpler approach to it. Okay, a simpler approach to it, alternative approach. Is to find the difference, the unrealized profits on disposal of plants. You multiply it with, okay, sorry, you divide it by the number of remaining useful life. And since it's a full year, what you should do is that you just take the whole. If it's not a full year, what you are going to do is to prorate it based on the number of months, which means in this case, I'll say since it's full year, it is the difference, which is the 2 million. Where is it? The 10 million divided by 5 years. That is what it means. And doing so will give you the 2 million, which is an alternative way of determining it. That will give you the same 2 million, which we have gotten here before. That is 10 million divided by 5 years. It will still give you the 2 million, which means either way, understanding of it matters. Which means this 2 is this 2 million, which is the same thing as this 2 million here. It's still the same, this 2, which is what all of us has determined together. Any question whatsoever? Therefore, that is that. Now, what would be the position if it's the subsidiary that sold the good, sold the plant, dispose of the plant to the parent. That is where we are going to end today's discussion. Who can give us a guidance before we put up the question? If it's the subsidiary that have sold the item, what are we going to say?
I think
The mic is open for you guys.
In that case, what will happen in that case is that the unrealized profit will be shared between the parent and the subsidiary in the ratio of percentage of ownership. Whereas
what would happen? What would happen to the? What would then happen to the excess depreciation?
That depreciation would be added back to the profit of the parent, because the parent is the one that actually depreciated in excess. That would be the flip side of what we just did now.
No, okay, can you explain again so that we can get it clearly? What happens to unrealized profit and what happened to depreciation?
Yes, for the unrealized profit, because it is the subsidiary that sold to the parent. So the unrealized profit the profit will be deducted. The deduction will be shared between the parent and the ACTI in the ratio of the percentage of ownership. For the asset depreciation, because the parent that depreciated, the asset depreciation will be added back to the profit of the parent. That is what
Okay, which means LCI will not be affected.
Affected by the asset depreciation.
I think you may be right. Let us look at this question. You read the question and let us follow your guidance to solving the problem. Over to you. And now, over to you. Can I hear you?
Oh, sorry. My mic was still off. Okay, illustration 11, and upstream. Can you hear me?
Yes.
Okay. An upstream transaction, sale of plant by the subsidiary to the parent. Arsenal acquired 80% interest in the equity of Chelsea as of January 1st, 2014, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as of December 31st, 2016. Income statement for the year ended December 31st, 2016. Arsenal and Chelsea. Revenue, everything in thousands. Revenue, Arsenal 600,000, Chelsea 390,000. Cost of sales, Arsenal 345,000, Chelsea 201,000. Distribution costs, Arsenal 75,000, Chelsea 45,000. Admin expenses, Arsenal 105,000, Chelsea 100,000. Other income, profit on sale of or disposal of plants. Chelsea only 10,000. Income tax 25,000. Arsenal 29,000. Chelsea. Movement in reserves. Retained profit brought forward 120,000. Chelsea. Arsenal 65,000. Chelsea. Profit for the year. Arsenal 50,000. Chelsea 25,000. Additional information. Chelsea sold a plant to Arsenal for 50 million when its carried amount stood at 40 million as at the transfer date being 1st January 2016. as at the transfer date, the plant has a remaining useful life of 5 years, and the pattern of consumption has since not changed. It is the company's depreciation policy to adopt a straight line method of depreciation. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million.
Okay, thank you very much. In this case, it's so glaring that Chelsea sold the plant to Arsenal, which is a parent, and he has made profit on it. And how do we eliminate the profit as at the reporting date, given that the transaction took place in that year? And also, how do we treat the excess depreciation adjustments? What Enharo has guided us on is that no matter what the amount of unrealized profit on the disposal of assets is, we need to eliminate that against the profit of the subsidiary, and which eventually will affect the shareholders of the subsidiary having to reduce their share of profit by that same amount, which then signifies that the parent would take a burden equivalent to 80%, the NCI will take a burden equivalent to 20%, while for the excess depreciation, the entity carrying the asset in its book is the parent, and it's the parent that has suffered excess depreciation, which have to be reversed eventually, and therefore it's only going to be something beneficiary to the parent. And to do this, let us more or less demonstrate that understanding by completing our model sheet. Now, in our model sheet, what then do we do? We come here to recognize the fact that nothing is changing in what we have done so far. But what we just need to emphasize is that now it is not Arsenal that sold, rather Arsenal bought. Therefore, who sold is Chelsea. I cut that and paste it in the front to change the narrative as follows: that Chelsea, which is a subsidiary, sold to Arsenal, which is a parent, and such a transaction is no longer a downstream, but an upstream transaction, which I have to emphasize. That is that in that regard. Which then means that everything remains the same, but the accounting entry is what matters now. What matters in this case is that this particular income, who has made the income in this case is the subsidiary. You can see the 10 million here. Therefore, the income will have to be debited in the books of the subsidiary, not the parent, as we had in the other case. Okay. Next, the asset is the asset of the parent, not the subsidiary. Okay. Now, next one is the excess depreciation adjustment. It's 2 million, which have to be adjusted for in the books of the parents, which means in this case, the parent assets and in the parent's book, which is the administrative expense. Okay, that is that. Now, the technical note we are now going to give here, we speak to the fact that the narrative has changed as follows. Since unrealized profit is attributed to sales of asset transaction initiated by the subsidiary. Now, it is the subsidiary that initiated it. Hence, the unrealized adjustment, the unrealized profit will be deducted from the profits of the parents profit of the subsidiary first, which invariably will affect the parent to the tune of its 80% stake, and the NCI to the tune of its 20% stake. That is that. The excess depreciation adjustment in this case, since it affects the parents, being the buyer and the user of the asset subsequent to its purchase, the adjustment will impact only the parents. And the NCI is not.
Mama, why you do something? Why you do something? Why you? What why you?
It's not affected. Let me put it in capital. Therefore, Nudi, I want you to read this. We'll see how it summarizes that.
Technical notes. Since the unrealized profit is attributed to sales of assets, transaction initiated by the subsidiary, hence the unrealized profit will be deducted from the profits of the subsidiary, which invariably will affect the parent to the tune of its 8% stake and the NCI to the tune of 20% stake. 2. The excess depreciation adjustment, since it affects the parent being the buyer and the user of the asset subsequent to its purchase, the adjustment will impact only the parent and the NCI is not affected.
Thank you very much. Therefore, in that case, we'll come here and find out the same adjustment as been affected, given that the information, okay, the information slightly changed. This is 105, 100. Okay, now this has nothing, but this has 10. Okay, now the only thing that has come up is that this adjustment now, how do we reflect it when we are attributing the profits? The profit is attributed to the parent and NCI in this order. But when you come to this, the aspect of the profit on disposal, it will be in ratio 80-20, according to what Enaro has said earlier, which I also corroborated. Why this only affects the parent. Therefore, what will I do is to recognize the product, which means 80% for the parent. Why 20% I will recognize for the non-controlling what? Interest. And that's how we come across our distribution. Whereas here, the adjustment is 100% adjustment against the parents, according to the technical notes and guidance that we have given. And based on that, we now have distribution of 64,300 as opposed to what we had earlier on when we had, what was the one we had earlier on?
1,004.
What we had earlier on was 61,654. Okay, now that is what we now have in the subsequent case is 64,000 and 3,000. And that is attributed to the fact that we treated it accordingly, be it an upstream transaction as opposed to a downstream transaction. Okay, any other question? Other information did not change here. Any other question? And that shows what we present in our accounts. Any other question?
Okay, it's clear, Mr. Miwa. But when we did the first one on mostly on the statement of financial position, we didn't use an Excel sheet like this.
Yes,
so,
we didn't use Excel sheets.
Like this. So
yes, but it's the same result. The reason why we are also using Excel sheet is because one, we want to introduce you to not just solving account on paper, but you're able to develop the skill on what is practicable in real life situation when you are doing that in the organization. And given, secondly, that your diploma exam in ACCA, CIMA exams, and some other foreign exams have moved to computer-based. So that one thing is for you to know, one thing is ability to do it on Excel, which is the standard required internationally. Therefore, that's why we are doing it like this.
Yes, I think I like this one because even you can easily make reference to it. Just go to Excel. We haven't listened to the lecture. Go to Excel, the previous listing, it's just straightforward. So I think we are missing something from the other one because I cannot make reference to that one like this. I have to listen to a video probably.
And you can develop it yourself. You can develop it yourself. Okay. At least today we started developing this from grassroots. Therefore, you also do the same thing.
For the other one. Okay. I think going forward, I think this one is okay. We can be using this one for other lectures going forward. Okay.
Okay. Any other question? Otherwise, we'll call it a day.
No questions, sir. It was fairly presented and is well understood.
Okay. On that note, okay, I want to hear you. Okay.
Now, I wanted to say thank you for the presentation. Appreciated. Understood perfectly.
Okay. No problem. Okay. Thank you, guys. Thank you, guys, very much. And we'll see tomorrow to continue from where we stop. And tomorrow we'll be looking at other greater adjustments. And I wish we can wrap it up tomorrow so that we can move into the next topic of discussion. Thank you very much, and God bless you guys.
You're welcome.